So picture this. You wake up and literally half of your house is just peacefully floating up into the sky, right? While the other half is actively collapsing into a sinkhole. Crazy scenario, but welcome to today's explainer, where we're looking at the pre-market briefing for May 27th, 2026. Right off the bat today, we are staring down a massive, almost absurd market event. Our primary mission here is absolutely critical. We have to separate a durable, structural market signal from what might just be one-time mechanical noise. We're looking at an Asian session that has literally split in half. SK Hynix just closed up an astounding 9.31%. That signals a massive shift in the AI supply chain. But what's really driving this incredible surge? Is it a fundamental re-rating of memory assets? Or is the market's plumbing just going haywire? Because whether you're positioned for a structural shift or a one-time liquidity flush is going to dictate your entire execution strategy going into the US Open today. Look at the initial conditions out of the Asian session here. It is a textbook divergence playing out right in front of us. It's exactly like the front of a speeding train hitting the gas, while the back half is violently thrown into reverse. On one side, the KOSPI surged by 2.25%, driven almost entirely by that massive 9.31% leap in SK Hynix, plus a solid 2.68% bump in Samsung Electronics. But instantly contrast that against the absolute sea of red over on the Nasdaq, which suffered a brutal 3.36% drop. I mean, it is incredibly rare to see two halves of the exact same regional market move this violently in opposite directions on the exact same day. Okay, before we dissect exactly why this happened, we really need to lock in the macroeconomic baseline. We aren't just reading numbers here, we're taking the temperature of the global pressure cooker. You simply cannot execute in the US session without understanding this environment first. So the Korean won is looking relatively stable, showing strength at 1,501.5 against the dollar. That means there's no widespread currency panic. The Korean 10-year yield is sitting at 4.093%. Globally, the US dollar index, or DXY, is holding steady at 99.1. And over in the energy sector, WTI crude oil is priced at $91.33, with Brent hovering at $93.46. Basically, these metrics show a relatively calm, stable global backdrop. And you know what? That stable temperature is exactly what makes this unprecedented divergence in the equity markets so fascinating. The reason the Asian market split right down the middle like this is because two entirely different, massive forces collided in the exact same trading session. On one track, we have a profound structural re-rating of AI infrastructure assets. On the other track, colliding at the exact same moment, we have a massive, one-time mechanical liquidity event. Think about it this way. A structural re-rating is like pouring a multi-million-dollar concrete upgrade into your house's foundation. It increases the permanent value. A mechanical liquidity event, on the other hand, is like a major water main bursting and flooding your living room. It's an intense, overwhelming flow of volume, but eventually the water recedes. When these two forces meet, the index rises overall, but the underlying components are moving for completely different reasons. And to trade this accurately, we really have to test each side separately. Let's start with that bursting water main, the mechanical liquidity shock, 4.32 trillion Korean won. To put that into perspective, that is an absolute tidal wave of capital forced into the market mechanics on a single day. Imagine trying to force a fire hose worth of water through a standard garden hose. That's what happens when 18 leveraged ETFs for Samsung and SK Hynix are listed simultaneously. This unleashed 4.12 trillion won in trust principal, plus another 200 billion in ETN proceeds directly into the market. That is an enormous amount of forced buying pressure. It is the very definition of a one-time flow event. Now let's move over to that structural foundation upgrade and see how it catalyzed the other side of the collision. While that 4.32 trillion won was flooding the plumbing, UBS fundamentally redefined how we actually value memory. Memory is no longer being viewed as just, cheap digital filing cabinets. It is now fundamentally recognized as the essential, high-octane fuel for AI brains. UBS officially reclassified it as an AI infrastructure asset. They applied NVIDIA-level price-to-earnings multiples to the entire sector, raising Micron's price target from $535 all the way to a staggering $1,625. This new narrative sent Micron up 19.29%, crossing a $1 trillion market cap for the first time. This structural re-rating is exactly what gave SK Hynix and Samsung the fundamental fuel to absorb that massive ETF inflow without totally breaking.
So how did this mechanical inflow actually play out on the KOSPI? Well, financial investment accounts dumped 1.33 trillion won in mechanical inflows straight into the market. This wall of money was so incredibly strong it completely absorbed 461.2 billion won in foreign net selling. It drove the KOSPI up to an intraday peak of 8,457. But here is the absolutely crucial point for active participants. The KOSPI closed much lower at 8,228, with fewer than 100 advancing stocks across the entire exchange. Think about that for a second. The money simply ran out by the closing bell. That high-to-close reversal, combined with terrible market breadth, is the ultimate, undeniable footprint of mechanical exhaustion.
And while the KOSPI was just gorging on that massive ETF inflow, the Nasdaq was being entirely starved of liquidity. We saw 67.1 billion won in foreign net selling combined with a massive 551.8 billion won in institutional net selling. That produced a total outflow of 618.9 billion won. Now, individual retail buyers stepped in, bless them, to try and catch the falling knife, absorbing 642.4 billion won. But as any experienced trader knows, trying to trade the Nasdaq during a massive institutional dump is essentially like trying to catch a falling knife while blindfolded. Retail volume proved entirely insufficient against the institutional weight, dragging the index down that brutal 3.36%. Section 1. The hidden crack, Nasdaq's collapse. Now, here's the thing. The ETF drain alone doesn't actually explain everything that happened to the Nasdaq. The true anomaly, the signal hidden deep in the noise, is that foreign investors were actually buying Nasdaq semiconductor equipment stocks throughout the session. Yet, despite this constant foreign buying pressure, the prices of these specific stocks still collapsed. So, why on earth is the floor falling out despite foreign buying? Well, the answer lies in a complete structural shift in short selling. Looking at the shift from May 20th to May 27th, domestic institutional short participation violently spiked from just 24.65% up to a commanding 67.36%. At the exact same time, foreign short participation collapsed from nearly 75% down to just 32.46%. Domestic institutions completely displace foreign investors as the dominant, overwhelming short force in the Nasdaq. We can actually prove this domestic short dominance by looking at three specific tickers, what we'll call our three canaries in the coal mine. First up, Technics absorbed nearly 35 billion won in foreign buying, but because a massive 50% of its volume was short selling, the stock actually sank almost 6%. Then there's Reno Industrial, which took in 21 billion in foreign capital, yet still managed to plummet 7.5%. Finally, Wanik IPS dropped nearly 8% even while fighting against 12.6 billion in foreign buying. In every single case, institutional short volume completely overwhelmed and crushed foreign buying. If you only looked at spot direction and foreign inflows, you entirely missed the invisible anchor that was dragging these stocks down. Grab a pen and write this down because this is what really matters for your positioning. The crucial point you must take away from the Asian session is this. The KOSD's decline had two entirely distinct sources. The ETF liquidity drain to the KOSP was a one-time mechanical event that is now officially exhausted. Over. Done. However, the institutional short structure dominating these semiconductor equipment stocks is completely independent. It does not expire with the ETF listing, it persists, and it is going to forcefully carry over into the next trading session. Section 2, U.S. Execution Mode. Now that we have those Asian initial conditions fully mapped out, let's pivot our focus to the U.S. session. We know the ETF supply is exhausted, but we have upcoming U.S. macroeconomic triggers that are going to finally decide if this memory re-rating holds its ground or if the entire sector compresses. We have some immediate hurdles to clear. The ADP non-farm pulse, which is a key high-frequency proxy for private payrolls, just printed at 42,250 this morning. That is up significantly from the prior reading of 33,000, clearly signaling employment acceleration. Furthermore, right after the closing bell at 1700 Eastern, we have major earnings from Synopsys and Salesforce. Active traders know that pre-positioning for these major software earnings might compress intraday conviction in AI-exposed hardware names, which could easily lead to a choppy, highly hesitant session. But the real intraday variables that will either hold or break this entire structure are the Federal Reserve speakers. We have Lisa Cook speaking at 12:55 Eastern, followed immediately by Lori Logan at 1300. Isn't it funny how the Fed always seems to have the absolute power to ruin a perfectly good structural re-rating with just a few carefully chosen words? These speeches, coming right after that accelerated ADP print, create a totally binary execution scenario. If they lean hawkish, watch out. Treasury yields will spike, the dollar will strengthen, and technology multiples will compress rapidly, basically reclassifying our massive Asian signal as just conditional volatility. But if they remain neutral or dovish, rate path concerns will ease, allowing the broader technology sector and this brand new memory re-rating to solidly hold its ground.
Which brings us to the most critical question of the day. With all this data swirling around, the ETF exhaustion, the hidden short-selling spikes, the structural foundational re-rating, and the looming Fed speakers, what is the ultimate tactical line in the sand? What is the specific level market participants need to be watching right now, before the opening bell rings, to validate their positioning?
30,198. Now, this isn't just a random number pulled out of thin air. This is the exact technical threshold where algorithmic selling is triggered on the Nasdaq futures, marked exactly at the pre-market 0500 Eastern Daylight Time snapshot. Everything we've discussed today fundamentally hinges on how the broader market behaves around this specific, heavily watched technical level.
Let's make the directives perfectly clear for your execution mode today. If the Nasdaq futures can stubbornly hold above 30,198, the memory sector upside scenario remains entirely valid. You can confidently trust the structural AI re-rating. However, if price action drops below 30,198, the aggressive pre-market signal is entirely unconfirmed. Below this line, it essentially means the heavy weight of the macro data and potential Fed hawkishness has completely overwhelmed the optimistic memory narrative. So as we head into the open, you have a choice. Are you going to be the trader drowning in the mechanical noise, or the one executing clearly on the structural signal? Understanding these unseen liquidity flows is exactly what separates those who just react from those who anticipate. The market really doesn't care which one you are, but I promise you your portfolio certainly will. If you want to anticipate rather than react and receive these deep dives on the closing of Asian stock markets before the New York stock market even opens, please make sure to subscribe. We'll see you next time.